share with you my first company analysis about a company that I truly love called Diversified Gas and Oil. DGOC is an American oil and gas company, and they mainly focus on the production part of the industry. This is also how they differentiate themselves, because they have a very low cost of production because they have no exploration costs to consider. Their market cap is in British pounds because they are active on the London Stock Exchange. Their financial statements are all in US dollars, so to calculate all the numbers correctly, we will need to use a market cap in US dollars, which is why I have mentioned them below the British pounds. Same goes for the price per share, which is in British pence, by the way. Here you can see their key valuation metrics. The one I want to focus on is the price to free cash flow. This is the most important one, because what this tells you is basically if you would invest in the company now, how many years until you will get your investment back, whether it is through paying off debt, buying back shares, or paying dividends. This is what you will need to see. This is extremely good number, extremely low, so it will be very hard to find a good, growing, healthy company with a price to free cash flow ratio of below 2. To compare this to some other companies in the same area, I have created a small table to show you the difference. DGOC is here on the first row, or column I should say, and next one is Cabot Oil and Gas. This one is actually a pretty healthy company. Like, if you look at their financial statements, you will see that the company is actually pretty good, pretty healthy, so it will probably sustain throughout the oil war that is currently going on. But if you look at the other one, this is Antero Resources, Range Resources Corporation, and EQT. I just forgot what it stands for, my apologies. And you will see that either they have a negative earnings, they either have a negative free cash flow, negative EBITDA, or a very high EBITDA. These are companies that you want to avoid. And what all these companies, or these three companies, have in common is that they have a very favorable price to book value. And basically, if these companies go bankrupt, you might get a lot of value based on just selling off the assets. But the bankruptcy is very likely, and they also have a lot of debt, so this is not a sure thing. That is something to keep in mind. But if you just look at DGOC, you will just see how healthy or how good the valuation metrics are looking right now. So, on to the key financials. DGOC has an average return on invested capital of 25%. This is a growth number, and it tells you how well they are spending their capital, so the money that they are able to spend. They are using this very effectively, and to give you a comparison, Royal Dutch Shell, also a famous oil and gas company, has a return on invested capital of 8%, meaning that DGOC spends their money about 3 times more effectively. Obviously, it's easier for a smaller company, so keep that in mind, but it is telling that it is a very healthy sign. Gas break even at $1.42. Here in the image below, you can see how their gas break-even price is calculated. You see two numbers, $1.18, which is their operating cash costs. What this means is it basically is the cost of production on an operating level, but they need to take into consideration the wells that they need to shut down or that they need to operate, and they need to take into consideration the interest that they have to pay on their debt. So, and they have to pay that off, obviously. So if you take that into consideration, their break-even price is $1.42. They have a dividend yield of 19.4%. This is extremely high, and it is sustainable for the next 18 months. This might surprise you because oil and gas companies are currently going through a very rough time since the natural gas price is on an all-time low, and the oil price, I believe today reached a 17-year low, so it's trading at about $23 per barrel, which normally it is trading between 50 and 60. So these kind of companies are going through a rough time, but they have a dividend yield of 19.4% and it's actually sustainable. The reason why I also mentioned this as a red flag or a negative thing is that I don't really care about the dividends, because this is just one way for them to return value to shareholders, or in this case cash to shareholders. And since they have such a high return on invested capital, like 25%, I don't mind to receive the money because I will just reinvest it. But if they didn't give me a dividend, I know that they would spend the money very wisely and they would get a 25% yield on that money. So for me, it's not the best that they give this dividend, but it surely tells you that the company is attractively priced. The company hedges their operational production for more than 90%. This is extremely important because they are a commodity business and they tend to fluctuate a lot, especially the commodity prices. And by hedging, they basically protect the downside so that they can keep their operational cash flow steady at a minimum. So if you look at the chart I added below, you can see that for the 2020 they have already hedged 90% of the gas production at a price of $2.70. If you look up again and you see the gas break-even price, you see that they basically have a lot of profit margin on that one. So that is actually looking very good. But if you look further, you see that for the fiscal year of 2021, they already hedged 66%, so over more than 6 months. And they go even further and you can see that they hedge up to 60 months in advance. But they do limit themselves in that regard, because they limit themselves that they will hedge only completely, or in this case completely at 90%, up to 36 months. So they leave some wiggle room to actually get a better hedge if a price would go up even further. But right now you can just see that the cash flow is protected, and that is very important. If you look at their balance sheet, and in this case the assets part of the balance sheet, you will notice that they have no cash or cash equivalents. And I say no cash, but it is below 2 million, and for a company that has over $1 billion debt, that is not a lot of cash. If you just look at the balance sheet, you will think that the company goes bankrupt within a week. And if you look at the next part, which is coming right out, you can see that they have a very high debt. The debt has been increasing, but their production has also been increasing, so it makes a lot of sense. But they have over $1 billion debt and they have no cash. So in order to see if this company is healthy, we had to look to the cash flow statement, and there you can see that they have a lot of free cash flow and a lot of operational cash flow. So they are basically a very healthy company that hedges in advance, so you know that for the next 18 months, or for a part for the next 60 months, they're going to be healthy. But you have to look further than just a balance sheet. So this is basically one of the drawbacks of a balance sheet. It is taken on a moment, and in that moment a company could have less cash or more debt or no debt, and a cash flow statement shows you more or less how the cash flow is coming in throughout the year. So keep that in mind. And some other negative thing, which is not really a financial thing, but I want to put it here anyway, it is that they lend money for acquisitions. What I would rather see is that they pay no dividends and they use that money for acquisitions. But they have a strict policy that they lend for 50%, and the other part is their own equity that they have available. So sorry, this is their policy. It's not a bad policy, but it is not the most optimal one in my opinion. But that is just how I would like to see a company run its business. If you just check all of this, information that I just shared with you, based on that information, I will tell you that it is a very good company and it's managed very well. On to the moats. Their moat has basically three important parts. First, they have no exploration. The exploration part of a company, of an oil and gas company, is a very let's just say it's not very cost efficient, because exploration is very costly. So the fact that they avoid this and they're still growing is actually very important, because you will know that they will consistently keep a low capex, or a low cost in general. On to the next one. They don't drill. They buy assets that have already been drilling, and they put those wells that are already there, they put them in production again, and once they're done producing, they shut them down. But they're not going to drill themselves. This is also very cost reducing, because it's basically reduced their capex by an insane amount. If you check different oil and gas companies, go look at Shell, go look at Chevron, Exxon Mobile, you will see that based on their operational cash flow, their capex is basically half. If you look at DGOC, you can see that the capex is less than 10% of the operational cash flow, or about 10%. So they are very cost efficient, which makes them very great. And that is basically their third point. They have very low production costs. As you saw on the other page before, you saw that they have a gas production cost of $1.42. And if you look at their competitors in the same area, their production cost is about between $2.70 and $3. So their production cost is basically half that, which gives them an insane moat. On to management. They have an extremely capable CEO. Rusty Hudson Jr. is his name, and this is a guy that grew up in the industry. His great-grandfather, his grandfather, and his father were all working in this industry. But he was the first one to go to college, and he went to a business school, and he studied finance. And after studying finance, he went to work for a bank for over a decade. So this is a CEO that understands the business very well, grew up in the business, and he has a background in finance, meaning that he knows how to handle money properly. And the whole policy, all the whole company policies, you can see this. If you check the presentations, if you check my presentation right now, you will notice that he is very well with money. The company has more than 5 management shareholders. If you look at the image below, you will see that on the 9th of March, recently, so a few days ago, the CEO bought an extra 350,000 shares at a price of almost 68 pence per share. He considers it to be very cheap, but right now he owns more than 20 million shares, so he has over a 3% stake in the company. He is not the only one that owns these shares. There's the co-founder, Robert Post, I believe is his name. He owns also more than 3% of the company, so over 20 million shares. And then you have 2 other chairmen, and you have the CFO, who also owns shares of the company. And what is important to note as well is that every quarter for the past year, these guys have been buying shares. They have kept buying. They believe that the company is attractively priced. And the last point that I would like to emphasize on is what the management does. They focus on return to shareholders, and you can see this on basically every sheet in their presentation. You will see how they distribute the cash flow, how they calculate the returns, how much money they borrow, how much they're paying off, etc., etc. Just it's a great company for a shareholder, and that is what we're basically looking for as investors. On to the valuation. I made this quick view of my suggestion of what to do at which price level in 2020. Meaning if it stays below 90, I suggest you to buy this company, and I suggest you strongly. If it goes between 90 and 130, I still consider it to be very attractively priced. So if you have some spare money and you're not sure what to invest in, I would suggest you to buy this company. Afterwards, I suggest you to hold it. After 200, it becomes to be valued around fair value, I would say. I think between 200 and 250, I would consider fair value, and afterwards, I think it's already over that. So you might say overvalued, but since fair value is considered around 200 and 250, I wouldn't say 250 would be instantly overvalued, but I do not suggest you to keep a company in this field at fair value, since it is not an attractive industry at all. But keep in mind, this is just for 2020. If the company grows more, if they buy more assets, I will have to reevaluate this valuation. And if they keep growing at a 25% rate, these numbers will increase in a similar manner. So please keep that in mind for future years. On to the pros and cons. They have an excellent cash flow policy. Here you can see what they do with their free cash flow allocation. 40% of the free cash flow goes to dividends. And here you see in 2019, after 258 million free cash flow, 105 million went to dividends. They initiated the share buyback program. They initiated this program at 120 pence. The current price is at 60 pence. So at 120 pence, they were like, okay, we can either pay dividends. No, we cannot, because we stick to a 40% dividend policy. So we can pay off debt, or we can buy back shares. Paying back debt will reduce the interest cost by about 5%. Buying back shares at this point at 120 will increase in a better result, because the dividend yield at 120 is about 9 to 10%, I believe. So that's basically what the thought process of the CEO was, and that is why they decided to initiate a share buyback program. Right now, as I said before, it is at 60 pence. It is very likely that once this program is over, they are going to initiate another share buyback program, because the company is only growing steadily and it has been reducing in price while the fundamentals have not changed one bit. As I said before, at the management part, they have consistent insider buying every quarter for the past year. 5 management teams, team members have been buying shares, having increased their own share amount because they were already owners of the company. This is a sign that basically most of the management members are confident in the company. And they also consider it to be attractively priced, which is very important. The commodities are trading at a historically low level. This is both a pro and a con. The reason why other people are selling is because, hey, the natural gas price is at a historically low level. This is not an attractive company anymore. I'm going to sell. But other people, on the other hand, are going to say, well, the commodity prices are at a historically low level, meaning that the company is probably trading at a very low level. So this might actually be a good chance to get in on this company. So this is both a pro and a con, so keep that in mind. And as a final pro on this part is they are going to move to the main market in 2020. So right now they are trading their shares on the AIM 26, I believe, which is the I would almost say secondary market on the London Stock Exchange. It is not an attractive market. There's people who would want to avoid this market, like small companies reporting less and stuff like that. Even though that's not the case with DGOC, some people will avoid investing in AIM just based on the fact that they're trading on AIM. So what they're going to do, they're going to move to the main market within 80 days, I believe. So instead of being on AIM, they're going to be on the FTSE, which is the London main market. This will also mean that they are going to be trading within an index of the FTSE of 350, I believe. So all the indexes that own or follow this index or partially this index, they will need to buy shares of this company, meaning that this is a catalyst. And once they switch, let's say within half a year, you could see that the fund managers will need to buy this company, which is very attractive, I'd say. So over to the cons. It's a US oil and gas industry, or US oil and gas company active in the US oil and gas industry. This is unattractive on its own. US oil and gas companies have, in general, the highest cost of production compared to Russia or Saudi Arabia. So based on that, people will initially say, I'm not going to invest in this company because I know that they are not doing very well. That obviously is an assumption, but if people say that, I respect it and I understand, because I've checked over 40 small and mid-cap companies and none of them were doing a good job, in my opinion. Only Cabot Gas and Oil, honestly. They do a good job, but they're not attractively priced. This is an oil and gas company, meaning that it is an anti-ESG investment. If you are looking for a good investment that does well for the environment, you probably do not want to invest in this company, even though they are mostly focused on natural gas, and natural gas is very CO2 efficient. In general, oil and gas companies are not attractive to ESG investors, so if you are one of those people, do not invest in this company. Currently, as of a few weeks ago, there's an OPEC oil war between basically Russia and Saudi Arabia, which is causing all the commodities that are related to this, like oil, natural gas, and liquid natural gas, to drop significantly. Like oil went from like $60 a barrel to like 23 today, I believe. So it's an insane drop. And if you think that this is gonna stay for like, let's say, more than 18 months, which is basically how the DGOC has hedged, how far DGOC has hedged, then you may want to consider not buying into this company. So to recap, the return on investment capital is great at 25%. They have no exploration and no drilling, which reduces their costs. They have a price to free cash flow ratio of 1.88, below 2, which is great. This means that you will have your investment back one way or the other in about 2 years at current price levels. They hedge to guarantee their returns. Sorry, there's a typo there. They have extremely low production costs. They started the share buyback program at 120 pence. Right now, it is trading at 60 pence. So even when the board and the CEO thought that it was attractively priced, you basically get it half off. There has been 5+ insider shareholders, and they are consistently buying shares for their own portfolio, which is a great sign. The commodities are at historically low levels. As I just said, they are constantly or quarterly buying back shares, and they're going to move to the main market in 2020. These are basically the main points as to why I invest in DGOC and why I'm so heavily invested in DGOC. Do you agree with me? Please let me know in the comments. If you have any questions, feel free to let me know in the comments as well. And if you want me to analyze a different company, you can also put those requests in the comments. Thank you for watching.